Insurers increased their holdings in private equity again in 2019 by nearly 10%. Here to discuss a new report on the subject is Jason Hopper, Associate Director, Industry Research and Analytics, AM Best. And Jason, insurers have shifted more money to private equity investments in the last few years. What exactly is driving that?
Hi, John. Thanks for having me. As you mentioned, private equity holdings have increased 40% since 2015 and clocked in at just over $81 billion in 2019. Life insurers have been driving that trend and account for about 3/4 of total insurance industry holdings. Commitments for additional investments are also up 10% in each of the last 4 years. So there has been continued interest and also into the future for a couple of years by insurers to continue to stay in this asset class. There has been a shift away from hedge funds and insurers that want to maintain exposure to other alternative assets have been shifting to private equity from hedge funds. There's been better returns and insurers have kind of soured on hedge funds in terms of the fees and kind of the lackluster returns that they're getting for their money.
So what does the risk profile of private equity investing look like?
So all of our rating units has different risk tolerance parameters, and companies do stay within their guidelines when investing in any asset or alternative assets. Another thing that they want to make sure is that they maintain adequate liquidity. As I mentioned before, with future commitments for additional investments, money is locked up for a period of time. So insurers are also wary how exposure affects their regulatory and capital models, as alternative assets and private equity do get higher risk charges than, say, rated debt. But private equity sponsors have been developing products and trying to customize certain offerings to help ease capital strain for insurers. But in general, insurers do look for experienced managers with solid historical track records. They do avoid emerging managers, and it's kind of rare that they provide money to managers before their first close. So they do like to see managers have, like I said, a proven track record and the ability to raise money before they kind of jump in with them.
How does participation break down by U.S. insurance industry segment?
As I noted before, life insurers account for roughly 3/4 of in total insurance industry holdings. But having said that, the average exposure at life insurers is less than 2% of invested assets for those companies that do hold private equity. On the PC side, it's just over 2%, so relatively the same range. So in general, a relatively minimal portion of invested assets. As I said, additional yield and diversification are two flashpoints that insurers do look for. Overall, the top 20 rating units that do hold private equity account for almost 3/4 of the total industry. So it is concentrated at the larger players, which do tend to have larger capital bases. But overall, only 2% of our rated insurers have private equity exposure greater than half their capital and surplus. So from that perspective, exposure is manageable.
So to what extent, Jason, is the pandemic impacting the private equity space?
So the pandemic has affected pretty much just about every asset class across the board. You're going to see it in potentially see it in commercial mortgage loans in the future. If delinquencies or defaults happen to pick up in a couple months, you're seeing it on the corporate bond portfolio with credit rating downgrades and things of that nature. Private equity deal closings have dropped over 25% year over year in the first quarter of 2020 compared to 19. But having said that, capital raised has increased over 20%. So all these private equity firms are kind of just sitting on this lump sum of cash waiting to eventually deploy. But the issue in today's environment is how to exactly value these companies when their revenue streams have been either substantially cut or pretty much stopped altogether in the face of the COVID-19 crisis. So with that dynamic, it's a little difficult to gauge actual values. So while there might be some type of lag or uncertainty over the near term when private equity might act, but once the economic gears start turning again, we think insurers will kind of contribute more money to this asset class to benefit from that and gain some additional yield.
Thanks, Jason.
Thanks, John.
This is Jason Hopper, Associate Director, Industry Research and Analytics, AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.